Most people have no idea they're sitting on a tax-free income machine, and the irony is they've been paying into it for years without ever learning how to turn it on. We're talking about the cash value inside your permanent life insurance policy. And if you don't know how to access it correctly, you could hand a massive chunk right back to the IRS. Here's the thing nobody in the financial world seems excited to explain. The way you withdraw from your policy determines whether you walk away wealthy or walk away wrecked. Life insurance companies built these products with a specific exit strategy in mind, and most policyholders never read that chapter of the manual. The catalyst for this conversation is the slow, creeping realization hitting millions of Americans right now that traditional retirement accounts, your 401s and your IRAs, come with tax time bombs attached. People are waking up to the fact that cash value life insurance, specifically whole life and indexed universal life, operates on a completely different set of rules, and those rules favor you enormously if you use them right. Think of your policy's cash value like a lake behind a dam. The water is yours, it's been accumulating, but there's a right way and a very wrong way to open the floodgates. Crack the dam the wrong way by surrendering the policy outright, and you trigger ordinary income tax on every dollar of gain, plus potentially a 10% penalty if you're under 59.5. There was a moment in the early 2000s when variable universal life policies were being sold as the retirement solution to end all retirement solutions. And then the market crashed in 2002 and again in 2008. And suddenly, all that optimism looked like a bad haircut photo from the 90s. The lesson the industry quietly absorbed is that the vehicle matters less than the strategy you use to drive it out of the garage. The psychological weight of sitting on cash value you're afraid to touch is real. Financial advisors hear it constantly, this paralysis born from fear of doing it wrong. But here's the balancing truth. When done correctly through policy loans rather than direct withdrawals, accessing your cash value is one of the cleanest income moves available to a retiree. The mechanism you want is the policy loan, which lets you borrow against your cash value without triggering a taxable event, because the IRS does not classify loans as income, full stop. Your cash value continues to grow as if you never touched it, the insurance company lends you money against it at a relatively low interest rate, and you receive tax-free income with zero reportable distribution. History shows us that every generation of retirees discovers this strategy about 10 years too late, usually after they've already torched their tax situation with unnecessary IRA withdrawals. The 1980s crowd missed it, the boomers largely missed it, and now millennials have a genuine window to get in front of it, which is either inspiring or mildly infuriating depending on how many gray hairs you've already earned. A common misconception is that taking a loan from your policy means you're stealing from yourself. But that framing completely misunderstands how the structure works. Your cash value collateral keeps compounding as if the loan never happened. The insurance company is essentially saying, we'll front you the cash, your account keeps growing, and you can repay it whenever you want or let it settle at death from the death benefit. The practical step-by-step goes like this. First, confirm your policy has sufficient cash value and is not a modified endowment contract, or MEC, because MECs lose the loan tax advantage entirely. Second, contact your carrier. Request a policy loan illustration showing the impact on your death benefit, and structure the loan amount so it keeps the policy from lapsing. Because a lapsed policy with outstanding loans is the one scenario that converts your entire loan balance into taxable income overnight. The discipline required here is the same discipline required in any long-term financial strategy. Don't overborrow, don't ignore the interest accrual, and don't assume the policy manages itself. Think of your annual review with a policy like a quarterly earnings call. You need to know the numbers, you need to know the trajectory, and you need to adjust if the story is changing. One more layer worth understanding is that this strategy fits neatly into what planners call tax diversification in retirement, having income sources that are taxable, tax-deferred, and tax-free working in concert. Policy loans serve as the tax-free bucket, and when coordinated with Social Security timing and Roth conversions, the combined effect on your lifetime tax bill can be genuinely striking. The philosophical bottom line is that the people who build lasting retirement income are not the ones who made the biggest bets. They're the ones who built systems, stayed consistent, and never let one bad decision unravel years of patient accumulation. Sizing your policy loans conservatively, reviewing annually, and keeping the policy in force is the entire game. You don't need to be afraid of the outcome here, because the math, when respected, is genuinely on your side. And preparation beats prediction every single time. Whether markets go sideways, tax law shifts, or inflation runs hot, a properly managed policy loan strategy gives you a lever that very few retirement tools can match. If you're ready to put this into motion, whether that's building wealth through real estate investing, tackling home contracting projects, or connecting with the right lenders, check out our links in the description below.